How much does an employee actually cost? Well, I can tell you this. It's more than their annual salary. Hi entrepreneurs, I'm Vicky Brown, and you're in the right place if you want to engage your team, boost your business, and grow your leadership muscle. So sure, we can look at things like overhead, the cost of parking, how much you pay for benefit programs, etc. But even if you don't have any of these things, you do have payroll. And that means payroll taxes. And there's more to payroll taxes than income tax. And besides, that's paid by the employee. But there are a number of other taxes that still apply. Some paid by the employer, some split between the company and the employee. Let's start with the federal tax load. Social Security and Medicare. Those are two of the biggies. Social Security is split between both the employer and the employee, and the rate is the same for both sides. You have to pay 6.2% of the gross wages up to a maximum wage of $147,000. Medicare, on the other hand, is at 1.45% of wages and doesn't have a maximum. Additionally, for anyone who hits $200,000 in wages, there's an additional Medicare tax of 0.9%. Now, the good news, if you can call it good news, is the additional tax for Medicare is only paid by the employee, so the company doesn't have to chip in at all. Now we move on to the joy that is unemployment. Unemployment is paid solely by the employer. And the fun part is there are two. One is federal, it's called FUTA or FUTA, and the other is state-based, and it's called SUTA or SUTA. The federal side is usually between 5.4% up to 6%, depending on a number of complicated factors that I'm not even going to go into today. Just know that the rate is set each year, so be sure to double check. The good news is you only owe FUTA on the first $7,000 of wages for each employee. So beyond that, FUTA stops. Now the state side is a different beast altogether. First off, state unemployment rates are set at the state level, so you have to check with your state. Again, they'll notify you of your rate each year. That's one of the many reasons you have to be sure to register as an employer in the states where you have employees, which is even more important now that people are remoting from any and everywhere. Also, your state will set the maximum amount of wages that apply to the tax. So again, be on the lookout for that notice. And since we're talking about states, let's look at some of the state-based taxes. Some states have state-based disability programs. We do here in California. For us, both the employee and employer kick in on this tax. Each side pays 0.9% of wages up to a maximum of approximately $113,000. Now, a quick note here. All of these are current rates and maximums, so be sure to check on the most up-to-date rates and maximums before you start running a payroll cycle. And don't forget, different states may have other taxes they apply. For instance, if the state has a paid family leave program, well, generally those are taxes the employee pays alone. But in California, we also have a state education and training tax, and that one's paid by the employer only. Also, some cities and counties have local taxes. New York is a good example of that. And then there are deductions that come from the employee's pay for things like medical insurance and other benefits, retirement plan contributions, flexible spending plans, etc. Now, generally, these deductions are pre-tax, meaning they aren't part of the calculation when you figure out how much taxes need to be paid. But one really important point, you have to thoroughly check on each one. Retirement plan contributions, for instance, still count in the calculations for both Medicare and Social Security. Many people, both employees and employers alike, misunderstand this piece. Generally, when you contribute to a retirement account, you don't have to pay income tax on that amount, but Social Security and Medicare taxes, well, they still apply. Now, a couple of important final points on taxes. If you have an employee that claims exempt from tax withholding on their W-4, that only makes them exempt from federal income tax. Both Social Security and Medicare will still apply. And unless they also claim exempt from income tax on their state withholding form, then state income taxes would also apply. And if someone does claim tax-exempt status, well, they have to do a new form every year. That's right, your records have to show a new federal or state withholding form for each year they claim exemption. So be sure to put a tickler in your calendar. By the way, one quick pro tip. Do not ever give an employee advice on what to claim, etc. These are their taxes, and if they get screwed up because you gave them advice, you will be in the soup. Just refer them to their financial advisor or accountant. Now, before you decide to bag the whole thought of putting people on payroll and just go the full independent contractor route, be very careful here. The states have continued to be explicit around what is and what isn't an independent contractor. And if you get it wrong, you can find yourself with all sorts of fines and penalties. And you might even get hit with both sides of those payroll taxes that are usually split between the employee and employer. So definitely get professional advice before you move forward. If you found this information helpful, please subscribe and share. And if you're struggling with how to get your business off the ground and what comes next, well then check out the Leader's Journey Business Builder. I designed this completely free video series to help you with figuring out who your customer is and where to find her, how to sell without selling, how to package and deliver your service, and much more. Check it out by using the link leadersjourneyexperience.com. And remember, your inspired leadership is the secret sauce to having a high-performance team and a wildly successful business that you'll love. I'll see you next time on Leader's Journey.